Recapping the jobs report coming out in early May, reporting on April, stronger than expected, and huge shifts we're seeing in interest rates here in the U.S. and where they're projected to be by the end of the year. Just to recap, Pete, 177 versus 130. A lot of jittery action around this number, back and forth. Obviously, you've always got revisions, and right now it's a more complicated time than ever in terms of what a strong job market means. Is there still lingering inflation? When will, tariff stuff actually kick in and hurt these employment numbers in the U.S.? So much hedging back and forth that we didn't see too many huge reactions right off the number, Pete, but they were expecting a worse job market here with the trade war turbulence. But they got what has been relatively normal, high 100s, low 200s at the end of the day. And you did, after the shakeout, Pete, see a couple of trends, which was equities continuing higher. They continued to bounce back off of this, and they were on a hell of a run there from the lows in S&Ps around 5,000, even now getting back above 5,600. But another interesting thing I thought, Pete, was that Treasury yields almost across the board were 10 basis points higher after this strong number, which, okay, it makes sense. But you saw some huge shifts here looking at the June rate cut probabilities, because the May, at this point, it was maybe 5 to 10%. Now it's essentially nil. The chances of a rate cut in June now, Pete, are 37%. They were 67% a month ago. And the day before this jobs number were 57%. So that's a huge hit that they take here, going from more likely than not a rate cut in June to now punting further out in time. What do you think about this huge shift?
I think having 3 rate cuts baked in, given the uncertainty, we all kind of lean was a little bit much.
Okay.
Now they're taking a little bit of it out. So it's down to 2.25, 2.5, depending on if you go. Some of what they did here was move them further out into later parts of the year. There's more towards December. So,
and we could take a look here at December, because while this did change, to your point, it only shifted by about 1 rate cut. But that is still, a decent shift. But to your point, you're thinking maybe this distribution was a little bit more vulnerable than people had thought going into, because you might think, oh, it's the non-farm at the start of May. Like, of course, it's an important number, but it's 1 of 12, and like, how meaningful can it be? It took a whole rate cut out of the December projection here.
Now, when I say it's not meaningful, we see right here in the market movement, it definitely drives markets. Long term, I'm not pulling away that I'm changing my expectations on things because what non-farm payrolls tells me. Because the one thing, as I mentioned before, you look at every previous month's revision and it's dramatically changed. And it's like, we did what on that? Now it's this? So I think what we've done is normalize expectations that there isn't going to, at this moment, be a great need for massive stimulus. And between the tax bill and possible price increases coming down, the Fed's not in a hurry to cut rates. So that was really the case when they had a much more aggressive number put into June. But it was that fear. What they've done is they've baked out a little bit of fear. I think that's actually premature baking out of the fear. So we'll see how that shakes out.
Well, the funny thing is, to your point here, while the U.S. dollar has recovered from its lows, it's not necessarily ripping higher the way that equities have, or that U.S. Treasury rates have, or the way that they're baking out these projections. And you would think that would be relatively one-for-one action, because the U.S. dollar got hit, obviously, on the way down in equities, on the way down in interest rates, and on the way up in these rate cut projection odds. But you're not seeing that U.S. dollar recovery. So to your point, a little bit of hedging. Yes, they're 3% off of the lows in yen, 2% off the lows in euro, but they're still down. U.S. dollar down more than 5%, which is a huge move.
Back and forth, which what we want, but they're holding on to the lower quartile, or depending on how you look at euro, the upper quartile of a big move. So I think I'm not so quick to move my scalping ranges in all the way to that one standard deviation level yet. I will give myself a little bit more wiggle room. What does that mean? I will miss a couple of things, but I'd rather do that.
Yeah. So we'll see where it goes from here. But yeah, strong U.S. jobs crushing the chances of rate cuts here in early summer and rallying back the stock market a little bit, but U.S. dollar not sold quite yet on the recovery here in the U.S.
We'll see. A lot of BOE coming up, FOMC, as you mentioned, and, of course, a barrage of new tariff agreements are supposed to be announced this week.
Very cool.
Just
All
like
right.
the ones last week. So this will be exciting to see. You know what? Lots of opportunity, lots of back and forth. Stay disciplined. Don't get caught in the past. What I mean is don't get caught that at some point the euro is going to see 107 or 106 again. It may. You and I don't know that. But we're going to accept the terms and structure we have right now, move forward with it.
Live in the moment. Very Zen of you.